what we're seeing today, I've seen countless situations. I've been investing money for 50 odd years, and it's not every year or even necessarily every decade, but it's happened many times in my career that we've seen situations which look as dire as it looks at the moment. And sometimes these situations for the stock markets are very short-lived, and sometimes they can last a decade. We don't know which, but sooner or later, it will come right. Businesses and directors of companies have a habit of figuring out which way to navigate the muddy waters. And the one thing you'll be sure is if you do come out of whatever you own, whether it be gold or silver or Bitcoin or equities or property, you are going into an asset, specifically cash, which is being printed faster than it's ever been printed before. And for one thing you'll be sure is if you do come out of whatever you own, whether it be gold or silver or Bitcoin or equities or property, you are going into an asset, specifically cash, which is being printed faster than it's ever been printed before, and for which there is no hope tomorrow.
You're watching Silver News Daily. Subscribe for more.
Silver is coiled like a spring, and most people have no idea what's coming. As headlines obsess over stocks and crypto, the real action is building in the shadows, deep in the silver market. Right now, the price sits calmly around $32, but beneath that quiet surface is a storm of pressure, a collapsing dollar, central banks scrambling to contain chaos, and a critical shortage of industrial silver that's growing worse by the day. And when these forces collide, we're not just talking about a small price move. We're talking about a detonation that could send silver soaring past $50 in a heartbeat. Think about this. Back in 2011, silver shot to $49 without half the fuel we're seeing today. No global trade breakdown, no energy transition hoarding industrial metals, no central bank credibility crisis. But today, every one of those factors is in play, and they're all flashing red. Physical demand is draining inventories. Mines can't keep up. And financial institutions that spent years shorting silver into submission are starting to sweat. If you're watching the mainstream media, you'll miss it. But the signs are everywhere. Prices holding firm while momentum builds. Bullish signals stacking on the charts. And beneath it all, a financial system that's looking more fragile by the day. The real question isn't if silver breaks out past $50, it's when. And when it does, it won't give you a second chance. So why is this happening now? And why are so few people prepared for what's coming? Stick with me, because we're about to peel back the curtain on the most explosive setup the silver market has seen in over a decade.
And gold went down with it, but not as much. Then we had a rumor that maybe they'll delay the tariffs by 90 days, and the stock market soared. And then President Trump, denied that and said there's absolutely no way we're going to delay the Trumps. They're definitely, we're not going to change a thing. And stock markets plunged again. And then the next day, Mr. Trump announced that we are delaying the tariffs for 90 days, and the stock market soared again. Now, you have to wonder what's going on here, because reality is nobody really knows where they're standing. But what's been going on as this has all been happening is gold has been holding up very well. And as of today, we are sitting at an all-time record. Yet the stock markets are down a good 10 or 15%, depending on where you look. So I think what's happened is the bubble in the high-tech stocks, in the NASDAQ, in the Mag 7, I think I'm not going to say it's burst, but it's deflating because the earnings expectations of these companies they were high and they're still high, but just a little bit less high. But when you adjust the rate of growth on a high multiple company, that can change the price a lot. And that's what's happened. We've seen these major stocks come down, in fact, most of them more than 20%. So people who've been into these stocks are now saying, well, they bought the dip and then it's gone lower after the dip. So they're starting to look around for other things. And I think this is where gold has been flying, because the asset allocators are now starting to redo their sums, and they're saying, what would have happened if we had an allocation of 2% or 5% to gold? And the maths says that would have reduced risk, reduced volatility, and improve returns. So asset allocators, for the first time in decades, are starting to add gold back to the portfolios. And we've seen in the last few weeks that gold has, in fact, been flowing into the gold ETFs, whereas for a few years, the quantity of gold in terms of tons in the ETFs has been going down. Now it's starting to rise. So the feeling is that the man in the street is starting to buy gold, both physical gold and going into the ETFs. Now, probably this is the first time you've heard me say it, because I've been constantly saying this gold rally is not the man in the street. It's been central banks and large strategic buyers, the sort of buyers who are able to take delivery of 100-ounce bars out of COMEX. Now, 100-ounce bars, we're talking about $300,000 or something like that. It's a lot of money. So these buyers were not mom and pop, but I think mom and pop is starting to come back into the market, but only very tentatively at this point. And I think that is why we've seen the gold price, because it takes a very small amount of money to move the gold price and the gold mining sector. I mean, we're looking at the gold mining sector. I looked today, GDX, for example, that's the ETF, which tracks the largest gold mining companies, up 5% on the day. So people are starting to think, how can I get exposure to the gold market? And I think that's coming back now.
Silver may look calm on the surface, but the tension beneath is undeniable. For the past week, prices have hovered around $32, flat, steady, almost boring to the untrained eye. But that's exactly what makes it dangerous, because what looks like consolidation is actually compression. And in markets, compression leads to eruption. Every session that silver holds its ground above the 50-day moving average adds more fuel to the fire. Traders know this. Institutions know this. They're watching for a break above that crucial $32.49 level. Not because it's just another technical milestone, but because it could be the trigger that unleashes everything. We've already seen silver clear its 200-day moving average. We've watched it test and retest the $31.45 to $32.19 zone, one of the tightest resistance clusters in recent memory. This isn't random. This is coiling, and the longer it lasts, the more violent the move will be when it finally breaks. Technical analysts are circling like hawks. The ascending channel is intact. RSI is balanced right at 50, signaling momentum is ready to lean in either direction. But here's the thing. It's not leaning down. Every time silver gets close to its lower support, buyers step in. That tells you there's demand sitting just under the surface, ready to pounce. And that support, it's moving higher. From $31.50 to $31.90, now near $32.21. That's a staircase, and each step is just one level closer to that explosive breakout. While the media debates interest rates and the next tech stock, darling, the smart money is focused on silver's price structure. They know what this kind of setup means. It's not just a bullish chart. It's a loaded spring. The big move hasn't happened yet, but the market is setting the stage. Quietly, deliberately, and when that spring is triggered, it's not going to creep higher. It's going to rip.
When I first arrived in Switzerland in 1985, it was fairly traditional. Every portfolio in a Swiss bank would have about 5% exposure to gold. But as the years went by, that exposure started to drift down, particularly from the year 2010 onwards. So gold was very, very strong up until about 2010. It had gone from almost, under $100 up to over $1,000. And then from 2010, it didn't really do very much for another decade. And as that decade was passing, stocks were performing extremely well. So money was coming out of gold all the time and going into stocks. So by the time I retired, which was 3 years ago, the official allocation of the bank where I worked and many other banks to gold was actually zero. Now, we had in terms of investment management, we had a tolerance of 5%. So you could actually get to your 5% gold if your clients believed in you believed in me, and they did. So we actually had a little bit more gold than we should have done according to the asset allocation tables, which should have been officially zero. But those numbers are now starting to come back. I got an email from a Swiss bank just probably 2 days ago, which it was, when I say it was an email, it was a PDF, investment recommendation report, 2 pages of what we should be doing about tariffs. And then right on the last line, they sort of added as an afterthought, another way to sort of protect yourself is to have some gold in the portfolio. And it was almost like an afterthought. So it's coming. I think the gold is coming into portfolios. And so I believe we probably have a long way to go, not least of which because the central banks are probably likely to be buyers more than ever. I mean, if you think what's happened in the world, we've had these very aggressive and surprising tariffs, not only on people or countries which Mr. Trump sees as his enemies, but also on countries which are supposed to be friends of the United States. Take Canada, for example. Very aggressive tariffs put on Canada, and Canada has retaliated. And 2 countries which are love each other and at total peace suddenly are having a spat over tariffs. Now, what's Canada saying? They're saying, well, I don't know what they're doing, but they must be thinking, can we trust what's going to happen next out of the United States? They punished us once, are they going to punish us again? What about all these treasury bonds we're holding? Now, Canada does not hold any gold, but it wouldn't surprise me one little bit if they're now rethinking that, and maybe they're one of the buyers of gold, which we don't know yet. We'll know that in a few months when the figures get reported.
While silver's chart is preparing for liftoff, the real accelerant is coming from the collapsing credibility of the U.S. dollar. Quietly, almost imperceptibly, the world is turning its back on the greenback. For decades, it was the pillar of global finance. Reliable, dominant, untouchable. But now, that foundation is starting to crack, and commodities like silver are standing by to pick up the pieces. Every time the Federal Reserve hints at rate cuts or kicks the can down the road on inflation, confidence in fiat erodes a little more. And when confidence slips, capital flows straight into hard assets. It's already begun. Central banks are hedging with gold. Investors are loading up on metals. And silver, still underpriced and overlooked, is positioned as the asymmetric play. The dollar isn't just weakening in charts, it's weakening in trust. And trust is everything. With the U.S. running trillion-dollar deficits, political division at a boiling point, and de-dollarization gaining traction globally, the world is asking one question: what replaces the dollar when it finally breaks? The answer isn't a single currency. It's value itself. It's tangible assets. It's things you can hold, things that can't be printed into worthlessness. Silver, with its dual nature as both a precious and industrial metal, stands in the perfect storm of monetary rejection. And this shift isn't about day trading. It's about capital preservation. The flight from fiat is accelerating, and the quiet demand building for silver isn't just a bet on higher prices. It's a bet against the system that's losing credibility by the hour. As the dollar falters, the pressure mounts. Because once trust breaks, it doesn't come back. And when that flood of money looking for a home lands on silver, it won't be a trickle. It'll be a torrent.
Well, first of all, gold has been well supported by central bank buying. China bought some more gold last month. That's in March. It was less than usual, but they bought gold nevertheless at an all-time record price. All the evidence is that central banks who are buying gold don't really care what the price is. They just want it. And I think the recent events with the tariffs will only accelerate the desire of central banks around the world, whether they be friends or enemies of the United States. It will accelerate the desire to have more choice than just US treasuries in their foreign exchange reserves. So, for example, this week we've seen quite a big decline in the dollar. It's gone from, if we look at the DXY, the DXY, which is the dollar index, it's gone from 103 to, at one point, below 100. It's slightly above 100 as I speak. And a few weeks ago, it was 109, 110. So it's come off quite a lot as people have been basically bailing out of the dollar. And I think I don't think this is necessarily people selling as private individuals selling the dollar. I think it's more likely that central banks, again, are saying, why are we so exposed to the United States with everything which is going on, and they're probably investing in European central bank bonds. They're probably investing in British gilts, even Japanese bonds and Swiss franc bonds. And the reason I say that is we've seen in the last few days quite a heavy sell-off in the US 10-year. We've seen the 10-year go from about 3.9% yield to 4.5% yield. Is just under 4.5, 4.49, something like that percent yield as I speak. So when the yields go up, that means the price of the bond is falling. So the US Treasury 10-year bond, the price is falling rapidly, but the prices of the bonds in other countries like UK, Europe, Switzerland, has not been falling in the same period. That's unusual because usually bonds around the world tend to be fairly correlated. They tend to move to some extent in tandem with you. I know I'm not talking about the long term, I'm talking about in the short term. Japanese excluded in that. So what that implies is that people, I think central banks are probably reducing their exposure to US Treasuries and are probably increasing their exposure to other things, including bonds issued by other governments.
Behind closed doors, central banks are panicking. They won't admit it publicly, but their actions scream it. Rate cuts are no longer a tool of choice. They're a lifeline. Balance sheets are swelling again. Emergency liquidity programs, once considered extraordinary, are now part of standard operating procedure. And what are these institutions buying with renewed urgency? Hard assets, precious metals. Gold, yes, but silver is next. Because when the game is up, when paper promises start to fray, central banks don't want risk. They want reality. The LBMA report shows it clearly. Record-breaking purchases of silver and gold bars in 2024, with some nations doubling or tripling their holdings in just months. The Royal Mint reported a 153% increase in bullion sales compared to the year before. That's not a signal. That's a blaring alarm. These aren't hobbyists stacking coins in their basement. These are national treasuries repositioning for systemic instability. And it's not just the West. Eastern economies, too, are converting reserves into metals. This is the quiet rotation from debt-backed currency to commodity-backed reality. It's not a coincidence. It's survival. They see what's coming. A reckoning in the fiat system and a hard pivot toward physical collateral. Silver's role in this is critical. It may not be the official reserve asset like gold, but it carries the same legacy and increasingly the same urgency. It's cheap, it's liquid, and it's disappearing from circulation. Central banks know that when trust collapses, silver becomes more than just a metal. It becomes a message, a hedge, a shield, and that's why they're moving now before the world wakes up and the price gets away from everyone.
And borrow a huge amount of money, hundreds of billions, maybe trillions of dollars to replenish the coffers, to put the money they've taken out of the pension funds back into the pension funds. So there'll be a rush to borrow money, and the market may not be able to absorb it, particularly if foreign buyers, foreign central banks, are not as present as they used to be. Now, there are some plans afoot, which I'll come to a little bit later, which would maybe change that. But the reality is we might have a debt crisis, a Liz Truss moment, if you know what I mean, a Liz Truss moment, where suddenly yields are starting to spiral above 5%. We're at 4.5% on the 10-year already. And when that happens, there'll be a lot of pressure on the Federal Reserve to be the lender of last resort. So what happens then is, although the Federal Reserve doesn't buy directly from the Treasury, it will pass through a broker-dealer on the way. But what happens then is the Federal Reserve starts to expand its balance sheet, its quantitative easing. It buys government bonds using cash, and the way it gets this cash is to print it. So on the liability side, it increases the cash, which is just printed, and on the asset side, it increases the assets, which are the bonds it's just bought. But when, of course, it starts printing all this money to buy these bonds, that's pumping short-term liquid money into the economy, which means that someone somewhere is getting it, and asset prices are likely to rise very, very rapidly. That would include the stock market. So long before we get to that point, the stock market will be recovering because the stock market will be anticipating that this is going to happen long before it actually happens. So probably just when we think the news has got as bad as it's going to get and it can't get any worse, that will probably be the moment when the stock market turns around on a sixpence and goes back up again. Now, the question was, is it good for the economy and world? Well, clearly overseas, many countries have part of their exports go to the United States. I think China currently is about 14% of their exports going into the United States. Other countries, some more, some less. So all these countries are likewise going to see job losses because they'll be exporting less to the United States. And therefore, they'll be having recessions of their own. That in the short run is bad for the stock market, but once again, we'll have exactly the same kind of situation where sooner or later, the foreign central banks will follow the lead of the Federal Reserve and step into the market as lenders of last resort to their governments, who will be trying to reflate the economy due to the recession.
Silver isn't just a hedge anymore. It's a necessity. The industrial world is consuming it faster than ever before. And unlike gold, this metal doesn't just sit in vaults. It gets used, transformed, and never returned. The Green Revolution has launched silver into an entirely new realm of demand, and the numbers are staggering. Solar panels, electric vehicles, semiconductors, even the sensors in your phone. Each one is quietly draining global silver supply every single day. Solar alone is a game changer. It already accounts for nearly 20% of global silver demand, and that figure is climbing fast. Governments around the world have committed to aggressive net zero targets, funneling billions into solar infrastructure, and every new panel needs silver. And not just any silver. High purity, industrial grade, irreplaceable silver. There's no substitute, no workaround. If silver runs out, the green transition hits a wall. Then there's EVs. The electric vehicle explosion is only just beginning, and each car contains up to 50 grams of silver in its wiring, batteries, and sensors. Multiply that by tens of millions of new vehicles every year, and you start to see the scale of the problem. And while demand rockets higher, the supply side isn't keeping pace. Not even close. But here's the kicker. The industrial sector isn't price sensitive like investors. They need silver, regardless of the cost. That means, as prices climb, demand doesn't fall off a cliff. It tightens. And that tightening squeezes the market even harder, feeding into a feedback loop where industrial demand and investment demand begin to compete for a shrinking pool of metal. This is no longer about speculation. It's about necessity. And once silver crosses the line from undervalued asset to strategic resource, the market won't just move. It'll break.
Down, and the ability to therefore manage the budget deficit will be reduced because they'll be spending a lot more money on social security, on unemployment pay and things like that, which will mean that investors will lose confidence in US debt faster. And if we go to the right to the end of the game, eventually we'll get to a point where the interest rates at the short end are falling rapidly as the Federal Reserve reduces interest rates over and over again to try and stimulate the economy. I'm absolutely sure the Federal Reserve is going to say the price hike is a one-off, unrelated to our monetary policy. It's not, so therefore we can ignore it. So the Federal Reserve is going to say our second policy is to try and get full employment, so we'll start to reduce interest rates. So I do think we'll get multiple reductions in short-term interest rates, but the longer rates, the 10-year rates, I think they're going to be rising as people start to lose confidence in the ability of the government to manage its ever-expanding national debt. And we mustn't forget that we're seeing these treasury yields rise at the moment at a time when there is a freeze, absolute freeze, because we reached the debt ceiling on increasing government debt. That freeze arrived in January this year, on the 3rd of January. So at the moment, to pay the bills, the United States is running down its treasury balances and raiding the government pension plans by not investing money into the pension plans. And by August, all those emergency measures will have run out. So they will probably, before we get to August or by August, have to raise the debt ceiling again. If they don't, they will default, but that's a very unlikely scenario. So we'll assume that they'll raise the debt ceiling in August or maybe in July. And when that happens, the government will have to go into the market.
The silver market's biggest problem isn't just growing demand, it's that the supply side is cracking under the pressure. For years, silver production has been quietly declining. Major miners are pulling less out of the ground. New discoveries are drying up. And with environmental regulations tightening and ore grades falling, even the most efficient operations are struggling to keep output steady. Meanwhile, physical silver is vanishing. Inventories are thinning. And no one's talking about it. Because once the public realizes how little silver is actually available, the stampede will begin. We're now staring down the fourth consecutive year of structural deficit. That means more silver is being consumed than mined and recycled year after year. The gap is being filled by depleting stockpiles, not by increased production. And when those stockpiles are gone, there's no easy fix. You can't print silver. You can't conjure it from thin air. Once it's used in electronics or solar cells, it's gone. Permanently embedded, unrecoverable for decades. And it's not just industrial use causing the crunch. Retail demand is surging too. Bullion dealers are seeing unprecedented buying from everyday investors. Coins, bars, even junk silver, they're flying off shelves. Premiums are spiking. Delivery delays are growing. And that's before we even get a real breakout in price. The illusion of plenty is fading fast. The truth is that silver supply is on life support, and the market's been skating by on momentum and complacency. But as inventories dry up, the veneer of abundance disappears. And what's left? A race for the exits where only the earliest movers get filled and everyone else is left watching the price surge, unable to buy, unable to catch up.
Well, so far it seems to have been an indiscriminate trade war. It's not very targeted. I mean, it's targeted by countries, but the basis on which it's being targeted on the countries doesn't make a lot of sense from my perspective. So first of all, when you impose tariffs, it means that the cost of things in your own country in general will rise in price. Now, one can call that a one-off, but there's winners and losers in that in terms of the domestic industry. So if we talk inside the United States, there will be some companies who manufacture goods and services inside the United States where they've had hot competition from imports from foreign countries selling cheaper. And that's going to be not such hot competition. So those companies will be able to sell more and make more profit. And that's obviously what Mr. Trump is talking about, and that's what he wants to do. He wants to bring manufacturing back to the United States. But at the same time, there's many companies in the United States who have supply chains outside of the United States. They may be making cars or machinery, and they're buying parts and components from all over the world. And as these parts and components come into the United States, they're going to be taxed, and that's going to put up the cost for those businesses in the United States, meaning those particular businesses are going to have to sell their goods at higher prices, and they'll be selling less of their goods, which means that over time, they'll have to lose, some people will lose their jobs, and the profits of those companies will be lower than they were because the margins will be squeezed. So it's not a one-way ticket for America. There will be winners and losers in America on this. But I think what it will do is generally it will gradually lead to a rise in unemployment and a slowing of the economy. I think we will get a recession in the United States. I think we'll get a recession globally. I'll come to that in a second. And obviously when that happens, that means the tax take will go.
One of the most powerful signals in the silver market is hiding in plain sight. The gold to silver ratio. It's a historic barometer, a kind of financial compass that has guided smart money for centuries. And right now, that ratio is screaming that silver is dangerously undervalued. As of the latest data, it takes nearly 100 ounces of silver to buy a single ounce of gold. That's not normal. That's not sustainable. That's a market flashing red for imminent reversion. Historically, the gold to silver ratio has hovered closer to 50 or 60 during balanced markets. But during times of crisis, when silver's true scarcity and utility are recognized, that ratio collapses. And every time it does, silver doesn't just catch up to gold, it sprints past expectations. In 1980, the ratio plummeted to 15 as silver rocketed to $50. In 2011, it dropped to the low 30s as silver made its last dramatic push to nearly $50 again. These weren't random. These were reversion events, snapbacks to equilibrium in a distorted market. The current ratio, near 100, is a distortion on a grand scale. It's a product of years of manipulation, paper trading, and institutional suppression. But the fundamentals are starting to overpower the fiction. Gold is already breaking records, climbing past $3,200 an ounce. And silver? It's still stuck in the 30s. That gap won't last. The ratio always reverts. And when it does, the move is violent. Investors who understand this aren't asking if silver will move. They're asking how far and how fast. Because a reversion to historical norms, just back to 60, would imply silver at over $50 today. And if we overshoot, like we've done in the past, triple digits aren't out of the question. The ratio is the signal. And smart investors are already positioning before the rest of the market catches on.
I've seen countless people commenting that gold has reached a certain level, $34, $33, $35, which they kind of see as a trigger point for the bull rally. I think we're going to have a rally, but I think the cutoff point where it starts to accelerate is somewhat higher than that. I'm talking north of $36 somewhere. But if we get above $36 and stay there for a few days, I think it's an easy ride up to 40 and beyond. Silver, of course, is going to be supported in the medium term by the simple fact that the mined supply of silver has been declining for a decade or more, and the consumed supply of silver is rising fairly rapidly. And the biggest consumption of silver, or the fastest increase in the consumption of silver, is coming from the electronics industry. Now, I know, and you know, that there will be more electronic goods on this planet next year than there are this year, and that's going to consume a lot of silver. So the estimates were that last year the electronics industry consumed 20% more silver than the year before. That might have been 23 to 24 or 24 or 23, 22, I can't remember now. But suddenly the Silver Institute was saying silver consumption is rising by 20% a year. And of course, the biggest component of that was the photovoltaic industry. And I've got a strong feeling that photovoltaic sector is growing quite fast. I mean, I'm getting far more knocks on my door than I've ever had from people trying to sell me solar panels on my roof. So I think it's become quite a mania in that area. But certainly the fact is, silver consumption is rising. We've passed the point where the consumption exceeds the mined supply a couple of years ago. The deficit's getting larger. The silver price has risen from around $20 to around 30-something, which it had to rise to suck out the scrap silver to fill the difference. And I think as that difference is going to get larger in the next year, probably the silver price has to go higher. But I don't think it accelerates away until we're above $36. I think it will just drift. It'll have its bad days and its good days. Nothing goes in a straight line. But we need to see it go above a certain level before it starts to suck in investors who say, I think I'd like to have some of that in my investment portfolio. I don't think there's a great deal of interest to buy silver bullion amongst the general public. I mean, the people who watch your show, they're intelligent people, so they're doing it. But there's an awful lot of people who just have no clue what the price of silver or gold is. I see that every day when I talk to my friends.
Some say China's industrial slowdown is bearish for silver, but that assumption couldn't be further from the truth. In reality, what's happening in China is masking a much larger story, the shifting axis of global silver demand. Yes, Chinese manufacturing has softened in the short term, but what's actually unfolding is a decoupling, a redirection of demand from east to west, and it's creating pockets of silent accumulation and stealth stockpiling that could ignite the next supply shock. Don't forget, China has historically been one of the largest industrial consumers of silver, especially in electronics and solar technologies. But as geopolitical tensions rise and trade barriers tighten, what we're seeing isn't demand vanishing. It's going dark. Major Chinese firms and state actors are quietly hoarding, not because they're bearish, but because they know what's coming. They see the deficits. They see the shrinking global supply. And instead of flooding the market with transparent buying, they're stacking in silence, preparing for a world where access to critical materials like silver becomes a strategic advantage. Meanwhile, Western markets are waking up. In Europe, demand for solar-grade silver is exploding. In the US, EV expansion is outpacing forecasts, and domestic refiners are now competing with industrial giants for every ounce they can secure. This is demand redistribution, not disappearance. And it's tightening the global balance sheet far more than mainstream analysts are willing to admit. The narrative of weak industrial demand is a smokescreen. It creates a false sense of security, a lull before the storm. Because once China ramps back up, and it will, the market won't just face rising demand. It'll face a full-blown bidding war, a scramble for physical metal between governments, manufacturers, and investors, all chasing a dwindling global stockpile. And when that moment hits, silver won't just rise, it'll lurch.
Okay, so Warren Buffett grew up in a gold bull family. His father, who was originally a poor man, became a very rich man by becoming a stockbroker in the middle of the Great Depression when nobody had any money to buy stocks, but nevertheless he made a lot of money. And he made so much money that he could go on and buy a bigger house and have servants. And he was elected to be a senator in the United States 4 times. And in his role as senator, he frequently spoke out against the fact that America had effectively gone off the gold standard for American citizens and was calling for a return to the gold standard. And he basically said things like, I can find no example in history where this ended well. Of course, America is a very large country with a very strong economy, so it will take longer, but the end result will be no different from what we've seen in places like Russia, where we had Bolshevism, or Germany, where we had Nazism, or China, where we had communism. The result has always been a bad ending when countries have separated themselves from the gold standard. So Warren, as he was growing up as a teenager, he'd have been sitting in a household where he heard nothing but talk about gold around the dinner table with his father's friends. And his father was giving to his, obviously fearing, and the father would say this, that he feared that the currency would go to zero. So he was buying for his daughters gold bracelets. Now, Warren, what did he get? A train set. Now, I don't know how Warren felt about it, but perhaps there was a little bit of jealousy there. So come the 1960s, gold is still illegal to own in America. And Warren Buffett, by his own admission, his father's dead, he buys a lot of silver. He's a silver bull, can't buy gold, but he buys silver because he can't buy gold. And then we get to 89, I think it is. And without the permission of Charlie Munger, he buys an absolute tons and tons of silver. I think it's about 30% of all the silver in the market. And obviously Charlie Munger, he doesn't say it like this, but he's clearly not too pleased. The way Charlie Munger put it at the shareholders meeting was something along the
All eyes are on silver's next move. And the charts are telling a story few are paying attention to. Technical indicators have quietly shifted into alignment, painting a picture of a market on the edge of breakout. Right now, silver sits just below the 50-day moving average at $32.49, consolidating in a tight channel while building the energy for a major move. This isn't noise. This is the calm before ignition. Every trader watching the daily chart sees it. Silver's price action is narrowing, volatility is tightening, and momentum is coiling with surgical precision. Let's talk setups. The ascending channel is intact, with higher lows stacking one after the other, each bounce confirming stronger, bullish control. RSI remains balanced, not overbought, not oversold, but hovering right at the midpoint, a launch pad. The market is waiting for a catalyst, and when it comes, the first signal will be a clean, sustained break above $32.49. That's the level. That's the trigger. Once silver clears it, the next target becomes the 6-month high at $34.59. Break that? We're staring down $35 and beyond. But here's the key. This isn't just technical. Fundamentals are fueling this chart pattern. Every data point behind the scenes, dollar weakness, central bank buying, industrial drain, retail demand, is aligning with what the charts are already showing. The market isn't just moving on sentiment. It's moving on reality. This kind of price behavior, tight, orderly, and rising, is often seen before major breakouts. It's the setup every professional trader dreams about. Low risk, high reward, and a technical structure backed by undeniable macro trends. Most of the world is asleep on silver. But those who understand this setup aren't just watching. They're getting in position. Because once this level breaks, the window slams shut and the chase begins.
Well, perhaps when we last spoke, a lot of people were saying that gold is flowing to the United States because it wants to beat the tariffs. But we now know that there are no tariffs on bullion. Yet the gold price isn't coming back as people say, oh, there's no tariff, I can sell it back. The gold price is moving to record levels. So we can actually deduce that the movement of gold to the United States and then the subsequent delivery of 100-ounce bars out of COMEX is because somebody actually wants that gold in their possession. Now, I don't think it can be China, because it wouldn't make any sense for China to ship gold buy gold on COMEX, like we ship from London, because they could just bought it in London directly. So I don't think it's China. So I think there's 4 possible candidates here. Of course, there will be some hedge funds who are taking a position. The second possibility is it might be the US government itself for various reasons, which we've all talked about, including remonetization of gold, including the question of whether the gold is really there to start with in the first place, and they're now getting ready for an audit. I think the gold will be there, but I'm just sort of saying what people are saying. The third possibility, for very good reasons, which I've outlined in writing, it might be Berkshire Hathaway, who have made comments in that direction in their latest quarterly annual report. And the fourth one, I think it might be, I've said at the beginning of this program, what about Canada? It wouldn't surprise me. Canada, who's got no gold, will say, God, we better wake up and get some.
Now here's where it gets explosive. Behind the polished charts and institutional headlines, there's a powder keg waiting to blow. And it's called the silver short squeeze. For years, a handful of major players, banks, hedge funds, and institutional traders have artificially held silver's price down with massive paper short positions. They've sold contracts representing silver they don't actually possess, suppressing the price and creating the illusion of abundant supply. But illusions can't last forever. And right now, the cracks are spreading fast. Here's the truth. The physical market and the paper market are diverging. On paper, silver looks plentiful. But in the real world, there isn't enough metal to cover even a fraction of these short positions if holders start demanding delivery. The COMEX vaults are thinning. London inventories are being drained. And if just a small percentage of contract holders call for physical delivery at the same time, it will create a cascade, one that forces shorts to cover at any price, no matter how high. We've seen glimpses of this before. Remember the Reddit silver push in early 2021? Dealers ran dry in days. Premiums exploded, and the system showed its vulnerability. But that was retail-driven, and it fizzled out. This time, the pressure is institutional. It's quiet, it's systemic, and it's far more dangerous. Once that first domino tips, once silver begins moving and shorts start feeling the squeeze, the momentum will be unstoppable. Prices will gap higher. Margin calls will force liquidations. And institutions that have been profiting off manipulation for years will be racing to exit a burning theater. This is the wild card, the black swan, inside a setup already brimming with bullish fuel. When the short squeeze begins, it won't be gradual. It'll be vertical. And when that happens, silver won't just reclaim $50. It'll blow straight through it.
Well, first of all, if anybody feels uncomfortable about any of the asset classes they probably hold too much of it. They should sell a little bit and then see how they feel. The second thing I'd say is, in the long run, the one asset class which will buy less and less and less is fiat money, paper. I mean, we've had, since the United States went off the gold standard in 1971, they've been printing dollars like there's no tomorrow. They've been exporting those dollars to foreign countries who've been then manufacturing goods or selling goods to America in exchange for paper, so selling their hard-earned labor for paper, which America is now saying, well, you've been cheating us. The question is, what? Nobody's been cheating America. America's been benefiting from the ability to buy lots of really cheap goods that they couldn't manufacture themselves at those prices. But now, as Mr. Trump has said, that has to some extent decimated many American industries who had hot competition from countries overseas who could produce it cheaper. But one of the things which I think was missing in the calculations done when these tariffs were imposed, they were only looking at the trade in hard goods. They didn't look at the trade in services. Now, in many cases, these foreign countries are buying a lot of services from the United States. So, for example, Switzerland, which is one of the countries which has been heavily punished because America exports less to Switzerland than Switzerland exports to America. But when you add in the services sector on both sides, which are supplying on the other side, you'll find that the figures are very, very roughly the same. So there is no deficit. And if I calculate it according to the number of jobs that Switzerland is creating in the United States, we're creating about just over 1 million jobs through our purchases of goods and services from the United States. And our salaries are slightly higher than the USA. And America is creating just under 1 million jobs in Switzerland due to the services and the goods that it buys from Switzerland. So we're pretty much, in Switzerland, we're pretty much on an even keel. Yet the tariffs imposed on Switzerland before they postponed them were very high. I think it was 41% or something like that, which only reflected the movement of physical goods and not the movement of services, where both sides are more or less balanced out.
Retail investors are waking up, and the rush is already underway. For years, silver has flown under the radar, overlooked in favor of flashier assets. But now, as trust in the system fades and mainstream financial media loses its grip, individual investors are starting to see the writing on the wall. And they're not waiting for Wall Street's permission. They're stacking silver, physically, relentlessly, quietly building a movement that's beginning to put serious pressure on the already fragile supply chain. Go to any major bullion dealer right now, and you'll see the signs. Premiums are spiking, inventory is vanishing, and delivery delays are becoming the norm. Coins, bars, junk silver, it's all being snapped up. And the reason is simple. People aren't buying silver for quick profits anymore. They're buying it because they're scared. Scared of inflation, scared of financial instability, scared of being locked out of real assets when the next big move begins. And what happens when retail starts to move in herds? We've seen it before. Crypto, meme stocks, gold in the 2000s. They all followed the same pattern. Early adopters get in, word spreads, social media amplifies. Then comes the tipping point, where the crowd panics, not because prices are falling, but because they're rising too fast to catch. That moment is coming for silver. All it takes is a spark, a mainstream headline, a viral clip, a sudden jump in price that confirms what early movers already knew. Then, FOMO kicks in. Dealers run dry, premiums double overnight, and silver enters parabolic mode, not driven by fundamentals, but by psychology. We're not there yet, but we're close. And when it begins, silver won't trade like a commodity. It'll trade like a frenzy, like a scarce, disappearing asset that people suddenly realize they need to own yesterday. And by the time that realization hits the masses, the cheap silver will already be gone.
Where I'm struggling I mean, I think there's two pulls on the dollar. One is upwards and one is downwards. Now, logically, when you impose tariffs on foreign nations, you buy less foreign goods. What does that mean? It means that you're sending less dollars overseas, and therefore your current currency should rise, not fall. But actually, it's falling. So what's happening is the currency is being overwhelmed by people who say, you know what, with everything that's going on, I don't trust what's going to happen tomorrow. No idea what's going to happen tomorrow. I have uncertainty. So they're selling US equities. They're taking that money home to their domestic currencies and basically selling the dollar. So at the moment, I think that's what's going on. There's net selling of the dollar because people don't know what's going to happen tomorrow. But realistically speaking, if you reduce your imports from foreign countries, you're paying less money overseas. Logically, your currency should rise, but that's not happening as we speak. So, in answer to your question, do I think the dollar index is going to go lower or higher? I'm sort of sitting on the fence. It could go either way because we got these two pulls going in opposite directions.
Everything is converging. The charts are primed. The fundamentals are undeniable. The pressure from both retail and institutional sides is mounting. Central banks are panicking, industrial buyers are hoarding, and the public is waking up. This isn't hype. It's a chain reaction. And the final spark that sends silver surging past $50 could come at any moment. When that fuse is lit, there will be no rewind button. We're witnessing the breakdown of a financial illusion that's been held together by leverage, manipulation, and paper promises. Silver's breakout isn't just a possibility. It's becoming an inevitability. The only question is whether you're positioned before it happens or watching from the sidelines. After the move has already begun. Because once silver clears that psychological barrier, once $50 is left in the dust, the narrative changes forever. If you're not paying attention, you'll miss it. But if you see what's happening, if you understand how rare this setup is, then you already know the opportunity in front of us. So stay alert, stay informed. And if you want to be on the right side of the biggest silver move in a generation, now is the time to prepare. Make sure to subscribe so you don't miss the next update as this unfolds. And remember, none of this is financial advice. Always speak to a professional before making investment decisions.